The last several years for watch trading values have been a roller coaster to say the least, with certain hype watches seeing unprecedented levels of appreciation in the secondary market, being multiples of their retail value. For example, in the spring of 2022, models such as the Rolex Daytona 116-500 LN traded at $49,183. The Patek Philippe Nautilus 5711 at $177,703. And then the AP Royal Oak 5202 at $118,413. Yet 2 years later, all of these pieces, including countless others, have plummeted in price. So what ultimately led to this massive rise and eventual collapse of the secondary watch market, and what does it all mean? Before we directly answer the question of what caused the downturn, we first need to understand what led to the creation of this boom in the market first. Since the advent of the iPhone in 2007 and the Apple Watch in 2015, you could argue that owning a mechanical watch or any watch in general is no longer a necessary tool for everyday life. Yet despite this, mechanical and especially luxury watches have been relatively steady, all things considered. If you look at the broader concept of Swiss exports, it does tell a bleak story for affordable quartz watch production, with the total Swiss watch exports dropping from 28.6 million in 2014 down to 20.6 million in 2019, a drop of nearly 30%. But as you shift over to mechanical watches, you will notice that the market has not seen the collapse that you might expect. In this period, you do see roughly an 11% drop in production, mostly as a byproduct though of the more attainable end. What became clear in recent years is that watches of the mechanical and high-end variety started to mean something different to buyers, where the concept of utility is there, yet it is no longer the main driving force for a purchase. A mechanical watch now is removed from the fast-moving world of disposable electronics that are chasing after the next technological improvement, where there's a short life cycle of obsolescence given the moving target that comes with continuous innovation. This divergence from the original found path as tools assisted watches to rather become collectible pieces of art, design, self-expression, and status that delivered a message that smartwatches could not fulfill. The numbers also back this up, with brands like Rolex, AP, Vacheron, Patek, Richard Mille, FP Journe, and others seeing more demand than they ever had before. This redefining began the wave that would come with the fascination in collecting, where the hype quickly followed pieces leading to hero products that could break through beyond the niche category of collectors to have widespread appeal. If I had to identify the tipping point for when the collector world collided with the broader public with just a moderate interest in watches, it would be back in 2017 when Paul Newman's personal 6239 Daytona sold for $17.8 million at auction. This number was absolutely staggering and enough to grab attention of the press and those outside of the watch buying circles, giving rise to a different type of collector that was driven by chasing the exclusive, all while the old school collectors remained captivated. This fervor at the top had a trickle-down effect to new products, where select brands that were primarily private in their operation saw an influx of interest for their watches at retail, leading to the dawn of waitlist. And that private point is an important one, as these brands could play the long game and did not face the same pressure to overproduce as a public company would that would be aiming for the best returns possible for shareholders. Hence why brands like Rolex, AP, Patek Philippe, and Richard Mille saw tremendous demand growth during the period. This rapid surge in inquiries for new watches released the perfect storm, as when watches became more difficult to buy, it set motion to even more fascination among a segment of luxury buyers, as the drive of validating whether a product was worth it was knowing that they had something others couldn't have. Simultaneously, places like China saw a boom in the watch market given the growing wealth in the nation and the swift boutique expansion by brands, with Rolex, for example, having over 160 points of sale in China alone. All of this gave rise to the flipping and dealing culture, where if you were lucky enough to get one of these watches at retail, your net worth basically jumped immediately as you walked out the door. Many people gave in to the temptation of selling to dealers, and some not so great business practices started to take place as well, with certain secondary market dealers hoarding inventory of unknown products as it became increasingly harder to get pieces at retail. At this time, authorized dealers were no longer able to showcase watches in display cases, since as soon as new products would come in, it would be spoken for. From here came the game of navigating wait lists, and in some circumstances with less morally upright ADs, you saw the maximizing of profit by selling directly to secondary market dealers closer to trading market values instead of retail values. And just as it seemed like it couldn't get any more out of control, 2020 came around and the lockdowns kicked off a very complicated time for the watch industry. On one hand, it was disastrous in the early months, as points of sale needed to be closed. In this industry, there are brands like Rolex that do not allow authorized retailers to sell online. Therefore, when lockdowns happened, it meant brands were essentially closed for business. Back at the factories overseas, you also had another issue that was brewing. As many of you probably already know, producing a watch that comprises hundreds of parts is not an easy manufacturing process to streamline, requiring a meticulous order of operation to ensure numbers and quality are met. The accepted industry terms for assembly are as follows. You have T0, the pre-assembly of smaller components of a movement, T1, the assembly of the movement and final adjustments, T2, the adding of the hands and the casing of a watch, and then you have T3, the attachment of bracelets or straps and preparing the final presentation box. I bring these points up because most watchmakers or technicians working for brands specialize in one key aspect of the assembly process rather than being able to do every step independently. Now, there are some smaller scale production and more bespoke pieces where one watchmaker will take it from start to finish, but as social distancing came into effect and people got sick, there was a massive issue in the production line, where if one unit of the assembly was impacted and can no longer work, it held up the broader production on a brand-wide scale. In addition, the shipment of raw materials and specialized parts like hairsprings, dials, and cases that sometimes might require shipment over country lines also were greatly disrupted. This combination of specialized workers that needed to work in close proximity with each other that could not be easily replaced while having difficulty in getting goods from suppliers was a recipe for slowed production. Looking at the data for Swiss watch exports from 2019 to 2020, we saw one of the largest year-over-year drops in the history of the industry, where total exports sat at 20.6 million in 2019, falling to 13.8 million in 2020, a roughly 33% drop in production in 1 year. This might appear to have been the death blow for the industry at this time, but it somehow also had some dramatically positive effects as well. Around this time, the health of global markets seemed to have a bleak future, so we saw one of the largest surges in governmental intervening to jumpstart economic recovery by way of stimulus checks, drops in interest rates, and quantitative easing, which led to an influx of cash. Since lockdowns were still very much in effect, travel and leisure were no longer areas where people were looking to spend their money, so those with the means looked towards discretionary collectibles. This only exacerbated those wait lists that existed pre-COVID, as the newfound liquidity in the market created people ready to spend absurd amounts of money, even well over retail. To provide a sense of what was taking place with the growing snowball of consumerism, a term coined by the 19th century economist named Thorstein Veblen. It is defined as the expenditure on or consumption of luxuries on a lavish scale in an attempt to enhance one's prestige. Following this research, it later unearthed that there were certain types of goods that countered the simple rules of supply and demand. In a typical scenario, goods that increase in price within the open market typically see a downturn in demand once prices reach a point beyond what buyers are willing to pay. However, in luxury goods where consumer behavior is much different and need is not the same, or even part of the equation altogether, there is a rare phenomenon that can take place where goods that see their prices go up can also see their demand rise, given that the difficulty to obtain is seen as a way to elevate status. This rare circumstance classifies these types of products as Veblen goods. And in this time of 2020 to 2022, watch collecting is one of the best examples of this concept in recent economics. To add fuel to the fire were individuals on the outside that were looking at the increasing trading market values and saw this as an opportunity to increase their portfolio of wealth, thinking watches could become an investment vehicle. The attention at this point was mostly being directed towards the big four. However, the focus on these brands led to others beginning to succeed. An example of this is a brand like Vacheron Constantin with their overseas models, specifically the Blue Dial overseas that peaked in April of 2022 at a trading value of $49,917, a number that doubled their retail price at the time. Yet since people struggled to get allocation for the Nautilus and Royal Oak, buyers were looking elsewhere, with this same effect taking place in countless other scenarios of alternatives rising in value alongside the top of market leaders. It was a completely unprecedented situation, and as the secondary trading markets sustained, you had brands that were basically printing money, since as soon as they had a watch prepared for sale, they had a line of customers ready to buy for nearly every model. The secondary market collectively peaked in the early spring of 2022, and positive momentum seemed never ending. However, as we all know now, things were about to change. Where it currently sits, the hype watches in the secondary market have plummeted in value since the peak. According to Watch Chart's Watch Index, which takes the trading value of 60 watches taken from the top 10 luxury watch brands, sorted and weighted by transaction value, it shows that the secondary market has dropped over 37% since March of 2022, being led by the highest gainers during the hype period, as well as being the reason for the big losses that came after this correction. So what ultimately created this mighty fall? The answer, in my opinion, begins with a domino effect kicked off with consumer spending and liquidity. After businesses and life began to operate more alike pre-pandemic times, we gradually saw a halt to the economic stimulus being created by governments, yet the after effect of years of pushing more money into the marketplace created rising costs of labor and goods through inflation. This swept up all the excess liquidity of certain individuals in the market to buy watches that were on the fringe of being able to make larger purchases, but also other goods in general, which indirectly slowed the hyper-consumerism that we saw when we were stuck in our homes with nothing better to do. As a way to slow the roll of inflation, interest rates then were bumped up, leading to less access to funds by buyers who were looking to purchase luxury items to show off their wealth, as well as dealers who were heavily leveraged in order to keep business operating. When interest rates increased, it changed the whole business dynamic for many of these dealers. And for those that did still have means, they now had competition for travel and other experiential expenditures being possible after years of needing to stay in place. Select markets around the world too were slower to open up than others, with China's economic recovery falling behind other nations, a country that was also one of, if not the top market for most brands. As less people were able to buy and others started to look elsewhere, the dip began. This in turn saw many of these speculating investors dumping their watches, since their held wristwatch stock was no longer the sexy item that had no end in sight to its increasing value. Concurrently, the calls to authorized dealers also slowed, as the ability to get something at retail pricing became less of a steal than it was before. There was also some difficulty on the brand side, which also contributed to the compounding effects. One point being that production was finally playing catch up, and in some cases, caught up too much. As brands were looking to maximize the rise during this period, they set out to produce quickly and to play catch up on the slowing output that came in 2020. So take the perspective of a brand. In order to have watches ready in 2023, you need to start planning and producing well before that in 2021 and 2022 for that fiscal year. Although companies can have sophisticated ways of forecasting, global markets and consumer behavior are complicated nuts to crack. So what many brands had to do was make assumptions on 2022 production and 2023 production during that frantic time of the secondary market acceleration, leading to some brands overproducing, therefore making their products easier to acquire, essentially serving as repellent to those that desire to own the most in-demand goods that others can't have. Another issue came down to pricing. First, it was simply getting more expensive to create products. So with material and labor costs increasing, watch brands also needed to increase their prices. Further, brands were actively looking at the secondary market. And since there was this large jump, there was no question decisions to increase prices in order to keep up, which potentially caused less interest in new products at their newfound MSRPs. As hype watches started to be able to be obtained more easily and the gap between secondary and retail values narrowed, the number of inquiries shrunk at authorized dealers, leading to more new products hitting people's wrists and the secondary market dealers looking to dump their excess inventory. Given how razor-tight margins can be, you saw certain businesses getting absolutely destroyed by the volatility where prices dipped 25% on certain models in a matter of months, leading to many secondary market dealers selling at losses to avoid the growing damage rather than holding on to hope for a recovery. In the last year, we've seen a relative return to normal for many of these watches on the secondary market. Wait lists are beginning to shorten, people are getting watches easier than they once were, and only the most hyped models are trading above retail, with many of them now seeing a much more realistic trading value. And as much as using words like plummet and collapse are accurate when looking at these past 2 years for select pieces, it is important to make a few things clear. Number one is that if you look at a 5-year window, it begins to tell a very different story, with many of these watches that have seen this fall in the last 2 years having an increase when you zoom out further. Secondly, watches that were impacted were the hype pieces, whereas brands and models that did not see this uptick are also not seeing this aggressive downturn. And then number 3, and lastly, this increase was never sustainable in the first place and for a long period of time. And what we are ultimately seeing is a fleeing of opportunists from the market that never had a deep passion for watches in the first place. Now, if I had to guess, there is probably still some additional correcting that will likely take place. And to me, that is okay. If you've watched this channel for several years, you know my philosophy on collecting. Buy what you love. Are there instances where the watch that you own can appreciate in value? Absolutely. That said, it is rare, and in my opinion, you should buy a watch because you enjoy it and you feel great when you're able to put it on, not because the amount of digits on the price tag. The collapse in the market for people like you and me is actually a good thing. This means more people that are passionate about watchmaking and horology will have an easier time getting to own the watches that they love. So if you find yourself aligning with this concept of passion in collecting, I really wouldn't worry that much about what is going on with the secondary market, as most of us in the enthusiast crowd are greatly unaffected, because why we're in this game in the first place is because we love watches. And yes, it is important to know what's going on, but I bring all this up as a way to understand what we saw was not something that was ever going to be normal for a long period. This whole industry has had a turbulent life cycle over the last century. And despite all of this change, the only thing that I will just remind many of you is just buy the watch that you love. But all right, guys, that is my video here today, trying to give a sense of what happened with the rise and fall of the secondary market. This was something I wanted to talk about for some time. I was actively just always monitoring this from afar, but as I mentioned, this is not something that really deeply impacts me, even with having a business, because who I speak to are enthusiasts. They're people that love watches, and I know that probably speaks for many of you that are tuning into this video. But if you enjoyed this deep dive, give this video a thumbs up, subscribe, hit the bell icon. That's also a great indicator for me that you like these types of videos. I know this is not the normal video that we do on this channel, but if you like seeing these, let me know, give it a thumbs up. Also check out teddybaldestar.com. teddybaldestar.com is an authorized dealer of over 30 brands, quick and fast fulfillment, dedicated customer support, full factory warranty for all the products that we offer, and also how we're able to fund all of our productions here is through selling watches. So if you are in the market for a watch, we'd love to have your business, allow us to keep doing what we're doing, and we love what we do. But guys, thank you again so much for watching. Be well, and I will see you all very soon.